Good evening from New York. It's 5:52 p.m. on Tuesday, April 14th, 2026. Welcome to the Lynx Data Insight Market Briefing. This analysis is AI generated by Lynx Data Insight and is for informational purposes only. It does not constitute financial advice. The U.S. stock market is now closed, and what a day it was. The S&P 500 is flirting with all-time highs again, oil is cratering, and we've got a genuine tug-of-war between geopolitical hope and inflation reality. Walk us through the numbers.
Let's anchor on the data. The S&P 500 closed at 6,966.78, up 1.17%, which puts it just 0.2% below the January all-time high. The Nasdaq posted its 10th consecutive daily gain at 23,634.11, up 1.94%. That's the longest winning streak since 2021. The Dow added 0.66% to 48,535.39. The Russell 2000 climbed 1.31% to 2,705.47. Breadth was solid. 329 advancing stocks versus 202 declining, a 1.63 to 1 ratio. The VIX dropped to 18.36, back below that 20 threshold that marks elevated risk. The 10-year yield fell to 4.26%. The 2-year sits at 3.61%, giving us a 65 basis point normal spread. This is a cautiously optimistic regime, risk appetite returning, volatility compressing, bonds rallying modestly as oil takes pressure off the inflation outlook. The two drivers are intertwined: renewed optimism around a second round of U.S.-Iran peace talks and a March producer price report that came in dramatically cooler than feared.
Let's unpack the PPI first, because the headline and core numbers tell completely different stories.
Exactly right. Headline PPI rose 0.5% month over month versus 1.1% expected, less than half the consensus estimate. Year over year, that's 4%, still hot, but well below the 4.6% economists had penciled in. The entire miss is explained by energy composition. Final demand energy prices surged 8.5% in the month. Gasoline alone jumped 15.7%, diesel 42.7%, according to the Bureau of Labor Statistics. But strip that out, and core PPI rose just 0.1% versus 0.4% expected. Year over year, core held at 3.8%, matching last month and undershooting the 4.1% forecast. The mechanism here matters. The war in Iran is creating a classic supply-side energy shock that inflates the headline number, but it is not contaminating underlying price pressures in services or non-energy goods. Services prices were essentially flat. That distinction is what gave the market permission to rally.
Now layer in the geopolitical catalyst. How much of today's move is the PPI and how much is Iran?
I'd split it roughly 40-60, with Iran getting the larger share. According to CNBC, WTI crude settled down nearly 8% at $91.28 per barrel, the lowest since late March. Brent fell 4.6% to $94.79 per the AP. That's a staggering move. The trigger was the White House signaling a second round of peace talks could happen, even though nothing has been formally scheduled. Vice President Vance said the ball is in Iran's court. Now, the U.S. Navy simultaneously commenced a blockade of Iranian ports on Monday, so there's a stick alongside the carrot. Macquarie strategist Thierry Wisman warned that the gap between the two sides is wide. The U.S. wants a 20-year nuclear suspension. Iran has countered with 5 years and won't surrender its enriched uranium stockpile. So the market is pricing hope, not certainty, and that's a structurally significant distinction.
The Nasdaq's 10-day streak is impossible to ignore. Is that purely geopolitical relief, or is something structural happening in tech?
It's both, and the breadth data tells us they're operating on different tracks. The headline index strength is driven by Magnificent 7 megacaps in semiconductors. NVDA closed at $196.49, up 2.97% on the day, up 6.29% over 5 days, its longest winning streak since 2023. The stock is above both its 50-day and 200-day moving averages, with a one-year return of 71%. Amazon surged 3% to $249.03, reclaiming its 50-day moving average after the $11.57 billion Globalstar acquisition to compete with Starlink. The stock is up 12.22% in 5 days and trading well above both its 50 and 200-day averages. Meta climbed 3.04% to $662.55, reclaiming its 50-day moving average after the 1 gigawatt custom chip deal with Broadcom. Alphabet added 2.48% to $332.93, boosted by Citi placing it on a 90-day catalyst watch ahead of April 29th earnings. But here's the contradiction. The technology sector overall has only 49.85% of stocks above the 50-day moving average, and 9.73% of tech names are near 52-week lows. That's a bifurcated sector. The mega-cap AI beneficiaries are surging, while software and SaaS names like ServiceNow, Akami, GoDaddy, and Ciena are in structural decline. Bespoke explicitly warned that the software bounce is still catching a falling knife. BlackRock, meanwhile, upgraded U.S. equities to overweight, noting tech's valuation premium relative to the market is at its lowest since mid-2020, which creates the entry point for the hardware and infrastructure side of AI.
That software bifurcation has real consequences for private credit. What's the read-through?
The private credit connection is the second-order effect that matters most. Software companies have been major borrowers in the $3.5 trillion private credit market. As AI disruption fears hammered those stocks, we saw fund outflows and rising default risk. Today's bounce helped. Blue Owl Capital rallied 8.5%, Ares Management 5.6%, Apollo 4.4%, according to the AP. But those names are still down massively year-to-date. Wall Street banks disclosed about $108 billion of exposure to private credit, per the Economic Times, and while executives say risks are contained, the transmission chain is clear. AI disruption hits software revenue estimates, which hits debt service capacity, which hits private credit NAVs, which triggers redemptions. If the software sector doesn't stabilize above its 50-day moving average, that chain stays live.
What does today's PPI data and the oil move mean for the Fed?
The two-year yield at 3.61% tells us the market is pricing the Fed funds rate near current levels, with roughly one cut embedded by year-end. That's consistent with Goldman Sachs's note today that only the Fed among G10 central banks is expected to cut in 2026. 6 other G10 governments are now expected to raise rates because of this energy shock. The core PPI data at 0.1% month-over-month reinforces that underlying inflation is stabilizing, even as the headline runs hot from energy. The Fed's reaction function here is well understood. They typically look through energy-driven headline spikes unless they feed into core or unanchor expectations, and today's data says that hasn't happened. The timeline for any cut is pushed out, though. Kevin Warsh's confirmation hearing is April 21st, and no new chair is going to lead with a rate cut during an active military conflict. Raymond James's economists said it clearly today. If geopolitical tensions prove short-lived and energy prices ease, the case builds for one cut later this year. But the prerequisite is durable conflict resolution, not just a ceasefire extension.
So, who are the clear winners and losers from today?
On the cyclical winner side, iQIYI led all gainers, up 12.7%, a Chinese internet and media rebound play. Micron Technology surged 7.17%, riding the semiconductor wave alongside that 10-day streak in the chip ETF, the longest since October 2017. JD.com gained 5.29% on the Chinese consumer recovery trade. Robinhood added 5.27% as Bitcoin touched $76,000, its highest since February. Moderna rose 4.59% in sympathy with the Novo Nordisk OpenAI drug discovery partnership. And Delta Airlines climbed 4.53% on the combination of falling jet fuel and United American merger speculation. Structurally, financial services is the standout sector, 81.88% of stocks above the 50-day average, 46.66% near 52-week highs, the broadest participation of any major group. Citigroup hitting its highest level since November 2008 is the proof point. Utilities are quietly dominant, with 71.21% above the 50-day and the highest near-highs reading of any sector at 56%. That's not just defensive positioning, that's AI data center power demand pulling the entire sector higher, as Bloom Energy's 23.77% surge on the Oracle deal demonstrates. Energy is interesting, 69.91% above the 50-day and the strongest 200-day breadth of all sectors at 88.5%, reflecting the embedded war premium in the longer-term trend.
Wait, energy having the best long-term breadth while crude just fell 8% in a single session is a contradiction worth exploring.
It's a timing mismatch that creates both risk and opportunity. The sector's 200-day breadth reflects months of elevated oil prices since the war started in late February. But the near-term picture is deteriorating. APA Corporation dropped 4.61% today, and energy has been the worst-performing sector over the last 10 trading days, down nearly 10% from the March 30th low. If peace talks succeed, the long-term breadth will compress rapidly as the war premium unwinds. On the loser side, the technology sector's internal fracture is the headline. 5 names in the top 10 losers. Akamai fell 7.24% on CDN and edge computing disruption fears. Gartner dropped 4.63%, reflecting enterprise IT consulting uncertainty. Ciena lost 4%, GoDaddy 3.37%, and ServiceNow 3.24%. Consumer defensive is showing the most distress structurally, 12.5% of stocks near 52-week lows, the highest of any sector, with only 45.61% above the 50-day. That's an active rotation out of staples as risk appetite returns. And basic materials is the sleeper data point. 0% of stocks near 52-week lows across 100 names. Complete absence of capitulation, supported by copper hitting 6-week highs on peace talk optimism.
Let's talk about bank earnings because JP Morgan and Wells Fargo both declined despite what looked like decent numbers.
Today's earnings drew a bright line between trading winners and lending laggards. JP Morgan delivered 13% profit growth and beat on both lines, but shares slipped 0.8% because they trimmed net interest income guidance. And in a higher-for-longer rate environment, NII is the metric investors scrutinize most for banks. Jamie Dimon's warning about an increasingly complex set of risks, geopolitical tensions, energy volatility, elevated asset prices, added a cautious tone. He also flagged that Anthropic's Mythos model is revealing a lot more vulnerabilities in corporate software, which connects directly to the cybersecurity spending narrative. Wells Fargo was the clear loser, down 5.7% after missing on revenue and net interest income. Citigroup was the winner, up 2.6%, beating on bond trading, equities, and overall revenue. The pattern is clear. Fee machines with strong trading desks are rewarded. Spread lenders dependent on NII are punished. This maps to the financial services sector breadth story. Nearly half the sector is near 52-week highs, but the dispersion within the group is enormous.
And the AI infrastructure theme keeps accelerating. Meta with Broadcom, Oracle with Bloom Energy, Amazon with Globalstar. How do these connect?
They all point to the same bottleneck, power. Meta committed to 1 gigawatt of custom MTIA chip deployment with Broadcom through 2029, with plans for multiple gigawatts beyond that. Oracle expanded its Bloom Energy fuel cell deal from 1.2 to 2.8 gigawatts because traditional gas turbines aren't available for years. Bloom can deploy in 55 days. Amazon's Globalstar acquisition for $90 per share in cash or stock is about satellite spectrum and infrastructure to compete with Starlink ahead of a July regulatory deadline.
The causal chain runs AI demand for compute exceeds supply, which drives hyperscaler capex into custom silicon and data center buildouts, which creates insatiable power demand, which benefits alternative energy providers like Bloom and pulls utilities higher, which is why utilities have the best near-highs reading of any sector. The constraint isn't chips anymore, it's electrons.
What's the risk case investors should be stress testing right now?
Our base case, which we'd assign 60% probability, is that ceasefire extension hopes and the cooler core PPI keep equities grinding toward the record in a range of 6,900 to 7,050 on the S&P, with the 10-year between 4.15 and 4.35%, and WTI oscillating between $88 and $98. The Fed holds through mid-2026 at minimum. The risk case, 25% probability, is that the ceasefire expires next week without renewal and the U.S. naval blockade escalates into a direct confrontation at the Strait of Hormuz. That would send Brent back toward its $119 war peak. In that scenario, the S&P could retrace to 65.50, the 10-year spikes to 4.5% as inflation expectations ratchet higher, and the private credit stress we just discussed goes from containable to systemic. Remember, headline PPI is already at 4% year over year, with energy up 8.5% in a single month. A re-escalation would push that considerably higher, force hawkish central bank repricing globally, and hit consumer spending through fuel costs. Albertsons noted on their earnings call today that lower income cohorts are already showing the most sensitivity to fuel and macro pressures. The upside tail, 15% probability, is a formal U.S.-Iran deal within 2 weeks that reopens normal Strait of Hormuz traffic, dropping Brent back toward pre-war levels near $70, while Q1 S&P earnings growth exceeds the 12.6% consensus, potentially reaching 19% with historical beat rates per BlackRock. That would take the S&P towards 7,200 as collapsing energy costs simultaneously boost margins and give the Fed clear runway for a cut.
So, how should investors be positioned?
Highest conviction, semiconductor and AI compute infrastructure names, NVDA, Micron, Broadcom, where demand visibility extends through 2027 and the 10-day momentum confirms institutional re-engagement. Maintain that exposure and add on any pullback toward the 50-day averages. Secondary conviction, utilities with AI data center exposure. The Bloom Energy and Oracle deal is the template for the sector, and the breadth data confirms broad participation. Gradually increase over the next quarter. Tactical, if the VIX pulls back toward 15 on continued peace optimism, use that as an opportunity to add put spread protection on broad indices as an insurance policy ahead of the ceasefire expiration next week. Avoid pure-play software names that remain below their 50-day moving averages. ServiceNow, GoDaddy, Akamai, Ciena. The 2-day bounce hasn't broken the downtrend, and the private credit feedback loop remains a risk. Also avoid taking new positions in E&P energy stocks here. The APA-style decline today shows how quickly the war premium can evaporate, and the sector's near-term momentum is deteriorating, even though long-term breadth looks strong.
How does it all fit together?
When you step back, this is really about the market pricing a peace dividend before it's been earned. The S&P is 0.2% from its all-time high. Oil has fallen nearly 25% from its war peak. The VIX has compressed from above 30 to 18 in just 8 trading sessions, one of the fastest such reversals in recent years. The core PPI data gives the Fed room to wait. The earnings picture is solid with 12+% growth expected, and BlackRock's upgrade to overweight reflects the institutional consensus that the conflict's economic damage is contained. The AI infrastructure cycle is accelerating so fast that it's reshaping the utilities sector and creating a new power constraint that will drive capex for years. But the alternative view deserves serious consideration. Macquarie's Wisman pointed out that the gap between U.S. and Iranian negotiating positions is enormous, a 20-year versus 5-year nuclear suspension, and historical precedents for peace talks between warring nations with such disparate positions are not encouraging. The IEA forecasts oil demand will contract by 1.5 million barrels per day in the second quarter, the largest drop since COVID, which means the growth damage from high energy prices is already materializing. And the IMF just downgraded global growth to 3.1% while raising its inflation forecast to 4.4%. If talks break down, the repricing of risk would be swift and severe because markets have already unwound most of the war premium.
Give us the 3 takeaways.
First, the risk. The ceasefire expires next week and the nuclear negotiation gap is wide. Do not assume peace is priced correctly at these levels. Carry portfolio insurance. Second, the market insight. Technology is the most bifurcated sector in the market, sub 50% breadth despite being the largest sector by market cap at $22 trillion. The winners are hardware and compute, the losers are software and services. Don't own the sector, own the right side of the split. Third, the positioning idea. The utilities sector's 56% near highs reading is the best of any sector, and it's being driven by a secular theme, AI power demand, not just defensive positioning. That makes it a rare asset that works in both the base case and the risk case, and it deserves a structural allocation.
Thank you for listening. This is Lynx Data Insight, and we will be back tomorrow with your next market briefing.